C3.ai is one of the most heavily shorted stocks in the market today. Shares of the company are 31.7% sold short. So in this video, I'm going to talk about the short case against C3.ai stock. I'm going to highlight if that case is valid, but I'm also going to let you know if there's a short squeeze opportunity here for C3.ai stock. So you're going to want to tune in, don't miss out, and let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with the case made against C3.ai stock by short sellers. So the short sellers, namely the Kerrisdale report that came out on April 5th, 2023, C3.ai looked at this letter and made a response to it, and they said that the Kerrisdale letter appears to be a highly creative and transparent attempt by the self-acclaimed short seller to short the stock, publish an inflammatory letter to move the stock price downward, and then cover the short and pocket the profits. Well, that shouldn't be surprising to most of you who've been following the stock market. That's what short sellers do. They take a short position in a company, and then they might follow up that short position in the company by issuing public statements trying to convince other investors to also short the stock or sell the stock so that it can help them make more profits from their own positions. So is that self-interested? Absolutely. It's absolutely self-interested. They're trying to make more money. That's what investors do. So let's look at if that claim has any validity. C3.ai ran an investigation, an internal investigation, to check on those claims to see if there was any validity to it. And they said that there wasn't any validity to it, that they looked at the complaints, namely the unbilled receivables. So Kerrisdale suggests, the short seller, that there's something unusual, nefarious, and or deceptive about our unbilled receivables balance as reported in our financial statements. So in simple terms, unbilled receivables occur when a subscription license or service is provided by the customer, which under US GAAP requires the revenue to be recognized in the current period, but some portion of that sales price is not yet due. And I will say this is, I wouldn't say this is extremely common, but I would say this does happen. Think of your Netflix subscription, right? When you subscribe to Netflix, let's say you pay for your whole year up front. Even if you pay for your whole year up front, Netflix can only count revenue 1 month at a time. 1 month at a time. It can't just count 1 year's worth of revenue just because you paid them up front. They can't count the revenue until they render the service. That's what C3.ai is talking about here, saying we rendered the service and so we counted it as revenue even though we didn't yet bill the customer. So what they're saying is we render our service for, let's say, a 6-month contract term, and then at the end of those 6 months, after we render the service, we send the bill for our service to our client, and then we get the money in return. So what Kerrisdale is saying is that that's unusual and nefarious and deceptive. I would say that would be stretching it a bit. I would say, yes, those contract terms are favorable to the client because the client gets to use the service for 6 months and then gets to pay, in the 7th month. So they're favorable terms to attract sales, yes, but I wouldn't say that's nefarious, or I wouldn't say that that is deceptive, especially because C3.ai has been transparent about the agreement with Baker Hughes, which I will go deeper into in just a little bit. The unbilled receivable balance related to Baker Hughes was 79.6 million as of January 31st, 2023. So Baker Hughes, one of C3.ai's, in fact, C3.ai's biggest client and a major shareholder in the company, of course, they've negotiated favorable terms in order to secure C3.ai's services, given that they're the biggest client and given that they're a major shareholder. But what Kerrisdale is saying is that this relationship is misreported, it's misrepresented, and because of that, the stock is overvalued and investors should short the stock. That's the case that Kerrisdale is trying to make. So let's go deeper into the relationship with C3.ai and Baker Hughes. So their relationship was initiated in 2019, and as a result of the partnership and the credibility and sales service capacity it has provided C3.ai in the oil, gas, chemical, and fertilizer market, C3.ai has booked more than 650 million in contracts and recognized more than 350 million in revenue as of the third quarter of 2023. So C3.ai is also benefiting from this relationship with Baker Hughes. It's not a one-sided arrangement where it's just Baker Hughes getting favorable terms from C3.ai. So Baker Hughes guaranteed C3.ai minimum annual commitments totaling 320 million over the 3-year term, and then that was actually extended in June of 2020. That agreement was extended to 5 years, and the arrangement expanded to 450 million, which was an increase of 130 million, or another 65 million per year for the last 2 years, which was smaller than the initial 3-year agreement of 320 million, which was almost 100 million per year. So the revenue arrangement decreased for the last 2 years. That's understandable. Business conditions have slowed down, and so spending enterprise-wide has decreased. So for each dollar of revenue sold into the market, Baker Hughes' outstanding payments obligations to C3.ai for products and services would be reduced dollar for dollar for the total amount of 320 million. So as Baker Hughes makes those sales, the commitments to C3.ai are reduced, right? That's what it promised. That as it delivers those sales, the commitments decrease. So in January of 2023, this agreement was again amended and expanded, and this amendment eliminated revenue credits for any subsequent deals in the Baker Hughes field, resulting in 32.5 million contract value increase for C3.ai. So more favorable terms for C3.ai. And then invoicing frequency accelerated from annual to quarterly on a go-forward basis, which is going to accelerate C3.ai's cash receivables. And if you've been following C3.ai, you would have noticed that its cash flow is clunky, concentrated in the fourth quarter, which is when it billed Baker Hughes, its biggest client. So that's when it was getting the money for its services in the fourth quarter for the services rendered throughout the year. And so that was creating a kind of clunkiness in their cash flow where they would be dry throughout the year and then they would get that big cash infusion at the fourth quarter. Now, as it's going on a quarterly basis instead of an annual basis, C3.ai can spread out the cash receivables and better balance the business going forward. Although, if I show you their expected forecast here, it doesn't seem like there's much change yet, at least until the year 2025, because if you notice, revenue here is relatively stable. It's going to drop after the third quarter down by half in the fourth quarter to 14.6 million from Baker Hughes specifically. And then fourth quarter is when they invoice that big cash out inflow. And then you'll notice again, first quarter 2024, second, third, and then again, fourth quarter big cash inflow, 68.8 million expected. And then again, lower cash inflow first, second, third quarter. And then again in the fourth quarter, a big cash inflow of the 86 million. So while it looks like they are billing quarterly, the quarterly billing amounts or invoicing amounts are still smaller, and then the fourth quarter has a concentrated amount, a big cash inflow that's coming in at the fourth quarter. Nevertheless, the relationship has been amended, and it looks like these amendments are more favorable to C3.ai. Again, highlighting that it's not just a one-sided relationship. Yes, C3.ai is benefiting from the support from Baker Hughes and their willingness to be a reseller of C3.ai services to other clients in the oil and gas field. But at the same time, Baker Hughes is helping C3.ai secure and generate sales, and they're buying C3.ai services themselves. I will admit it is a complex relationship. It's not a typical relationship. It's not a common relationship. But you can see here that C3.ai discloses these relationships, discloses the terms. So I would say it's a bit stretching to say that it's in any way nefarious or um, not transparent, because they are releasing the information here, and it looks like they are disclosing the relationship and the terms of the relationship here. So ever since that report came out around April of 2023, you can notice the stock price crashed immediately after. C3.ai stock price falling from over $30 per share down to less than $20 per share. But then immediately after, investors, perhaps seeking an opportunity for a short squeeze, jumping in and pushing C3.ai stock price to the highest point of the year, over $40 per share. But since the peak around May or June of early this year, the stock price has fallen down to $25.92, below the over $30 per share the stock price was trading for when the short interest really exploded and the letter came out from Kerrydale. So I would say mixed results for the short sellers in terms of influencing the stock price. An initial downturn, yes, but then a big spike upward right after that. Now, I want to look at a few factors from C3.ai to answer if there's an opportunity here to catch a short squeeze. Looking at the company's revenue, we'll notice that C3.ai has grown nicely from around 90 million to about 266 million in annual revenue in the most recent update. Although we did notice that revenue is expected to slow down from one of its main clients. And then you can remember artificial intelligence, what C3.ai is offering its clients is improved performance using AI, and that's been the most popular investing trend in 2023. Also, C3.ai has just introduced a new product into the market that they're sending out in trial, and their clients are trying it out, and they're expecting to get a big boost in sales in the fourth quarter of this year and the first quarter and second quarter of next year as clients start to buy that product that they're trying out right now. So good prospects in revenue terms for C3.ai. That being said, C3.ai is losing a lot of money on the bottom line, negative 106% operating profit margin, and that's been decreasing over time. That could partly be due to the favorable sales terms it offers to Baker Hughes and the fact that it's still investing in new technology. I just mentioned that new artificial intelligence product it launched into the market. And so I wouldn't be surprised if operating profitability improves in 2024, although we need to see a big improvement because this is heading in the wrong direction and heading there fast. I also wanted to look at cash flow quarterly because of the clunkiness in cash flow from operations I noted earlier with C3.ai. I can see that here in the chart played out, where in the fourth quarter or in a certain quarter, C3.ai might be cash flow positive, but for the most part, its cash flow is also heading in the wrong direction. Although for 2 consecutive quarters now, they've been cash flow positive. So let's see if when it updates the next quarterly results, if it is again cash flow positive or if it goes downward again. And finally, I wanted to look at C3.ai stock valuation, and it's trading at a forward price to sales of 8.266, which is on the cheaper side of its historical valuation. It used to trade at a forward price to sales of over 60, which I would argue it never should have been up there, but that's besides the point. Right now it's trading at a forward price to sales of 8.266, which is not cheap. It's expensive. It's more expensive than one of its rivals, let's say Palantir. Palantir is selling at a cheaper valuation than C3.ai. So to answer the question, if I think this is a short squeeze opportunity, or if investors should jump in and buy C3.ai stock, I would say no. Even though I would say that the claims from the short sellers are a bit exaggerated, I wouldn't go so far as to say that this is a short squeeze opportunity. I would still caution investors to stay away from C3.ai stock because of its, losses on the bottom line and the expensive valuation. Those are reason enough to avoid C3.ai stock. But before I let you go, if you've gained any value from this video, please subscribe to the channel. It'll help support videos just like this one. Thank you so much for watching.